Yeah, good morning, everybody. Thank you for joining our call on Friday. Um, it's been an incredible couple of weeks, I must say, and very, very stressful. Paying a lot of attention to all the noise out there. There's a ton of noise, and we can speak at length about this. We continue to stay focused on owning smart companies. Um, Unfortunately, right now we're trading lower as we speak. Um, uh, Donald Trump is, of course, driving all this. One man is moving a lot of boards around the international chess board. Some of it's going to stick, some of it won't. I cannot predict Donald Trump's next move. I will say, and probably the most powerful statement I'm going to say today, the most powerful force that will ultimately determine the proper direction is the market. If the market goes lower, Donald Trump will lose money. Elon Musk is losing money. And more importantly, their constituents, who are the rich, are losing money. And the rich don't like to lose money. And the more of us not, the more the market falls. The good news is in front of us as well. Um, Donald Trump will initiate deregulation, which will be good for the market. He will initiate tax incentives, which is good for the market. And he will, at some point, initiate some pro-growth initiatives that are true pro-growth. His closed-knit economy, his protectionism, academically is asinine. But he does want to make America great, and he wants to put America first. So we have to respect what his mantra is. Personally, I think he's doing huge damage to the American brand. He is making enemies very quickly. He is losing friends. Border towns are frustrated. They see their friends on the other side, and they're turning into foes pretty quickly. Our prime minister, yes, Justin Trudeau, his approval rating has skyrocketed in the last few days. Things are just flipping around at a very, very erratic pace. I do not like to do anything in an environment like this, just because things turn so quickly. Points of capitulation, points of maximum pain, tends to be the darkest moments, and it's always darkest before dawn. The weekend's in front of us, got 48 hours. I'm sure there's going to be some drama coming at us. Perhaps some good news too. Do not know. But this will pass. I've been through moments like this. This is not as bad as it's been, although emotionally it's wreaking havoc with my mental well-being. I often advise do not spend too much time with the media. It'll take you into dark places. I'm well aware of that advice I give. When I watch the media, and I happen a lot recently, just trying to stay abreast of the changes, it's taking me to very dark places. I looked at the charts of our company this morning, and for the most part, we have stocks that continue to trend higher. Yes, they've corrected. They got a little air pockets given back, and that's what's going on. There's a bit of a revaluation taking place. I am seeing some money leave America. My personal bias, if I were to trade off emotions, would be to exit all of my money from America. But that would be an emotional trade. That would be a wrong trade to do. But some money has left America, and I see that because I see European indices making all-time highs. The EFI index looks quite strong. The Global 100 index looks quite strong. So there are some green shoots. Some Chinese names look good. So we do have a few Chinese names on our book. Some Alibaba, some Tencent. They look quite strong. Bought some Siemens recently. That looks quite strong. Tech names in America on the flip side, and especially higher beta names or torquier names have been under quite a bit of pressure. I'm going to share with you on the first page of the slide deck, if you may turn to it. It just shows you the value. It's actually a very fascinating piece because I do want to put some money into Europe, and we have the bulk of our money in America. This slide shows you the valuation of each country's stock market and the value of its stock market relative to its GDP. This is not the size of the economy, it's the size of the stock market. Now, the size of the economy is the size of GDP, so you can do the math there. The United States is the biggest market in the world. Its stock market is worth $62 trillion. It is by far the world's largest market. In fact, I think it's about half the world's market. Again, my heritage is in Germany. You go down, and Germany is the powerhouse of a country in Europe. Germany's stock market is tiny. It's 2 trillion, which is 60% of its GDP. Compare that to Canada, which is a much smaller economy. Our stock market is almost 50% the size of Germany. In fact, it's more than 50% the size of Germany's. It's 3.4 trillion, or 160% of our GDP. In Germany, they got a lot of amazing companies, but they don't go public. They think about business differently. And I just had Ben Fawcett in my office, and he was on our radio show this weekend. Ben is one of our in-house portfolio managers, very seasoned individual, understands the global landscape quite well. And we spoke about Japan as well, the world's third largest stock market. Huge cultural differences, the way Americans think versus Japanese think versus Europeans, Germans think. And just to summarize, Americans, far right, very profit driven, very market centric, capital focused, but make money at all costs mindset. Japan, exact opposite. Don't offend anybody, cover up your mess, hope time solves your problem, don't be as innovative, don't change as much. A lot of cross ownership amongst business. In other words, if one company does business with a supplier and is long-term business with that supplier, they will buy a piece of that supplier's business and end up on the supplier's board. So there's cross ownership with their own supply chain, which is interesting. It convolutes the situation longer term. And Warren Buffett hates stuff like that. He likes being businesses. Germany and Europe is sort of in between the Japan mindset and the American mindset. They are becoming more market friendly, more profit driven, but heritage and social issues, good, bad, their decision affects their markets. But money wants to move to other parts of the world. It just is finding that it's not as market friendly as capital efficient friendly. The thing about capital is funny because capital makes countries efficient. Technology makes people more productive on a per capita basis. And that's where America wins. That's where Japan falls short, and certainly Canada falls short. We're not a very efficient country. And how do you make up for your inefficiencies? With a weaker currency. And so that's exactly what we're saying. You can also compare Canada often to Australia, very similar economies. But again, Australia's stock market is half that of Canada's stock market, and it represents about the same amount of percent of GDP. So we have a bigger economy than than Australia. If you look on the right-hand side, this shows you how many public companies exist in each country. This is important because basically in America, there's just under 5,000 publicly traded companies. If you would have gone back 25 years, there would have been probably 6,000 publicly traded companies. So there are less companies in America to trade, but still a lot of companies. The 500 largest companies out of this basket of 4,600 make up the S&P 500. On that list, Jack and I have created a quant screen, and we've taken those 500 and filter them down to 200 companies based on capital efficiency, based on value. And that's what we trade in our US quant strategy. And that strategy is actually one of our best performing strategies year to date. We do the same in the Canadian portfolio in the TSX. So in America, they got 4,600 companies. 500 make up the index. Those are high blue chip companies. Then you get to mid caps and small caps. Germany has 10% amount of companies. It has 400 companies you can trade in. The Netherlands, number 13, has 100 companies that you can trade in. So if you're domestically focused in the Netherlands, you do not have a lot of companies to choose from. Obviously, the Netherlands they're going to own shares across Europe, and that is basically, this home bias does exist, and the world is going to pivot away from that, and I think start to think a lot more globally. The question is, this U.S. money, if it leaves, where can it go? And is there big enough room for it all to go to? And the answer is there is not. All the money can't leave America because it's just too big of a market. The world can't absorb all of that. But at the margin, a little bit leaves. It'll, have a little effect downwards on the market and, again, motivate Trump. I repeat, the market is going to force Donald Trump to make the right decisions at some point. Question is, how much pain can he tolerate? I think he has a very fragile ego. I think he can be very, very hypersensitive. And someone just has to learn how to manipulate that man. Unfortunately, right now, he is the strongest, most powerful man in the world. I'm going to say he's a bully, and I'm going to say he's using his power in a very ill-mannered manner. But America first is his mantra, so we got to respect how he thinks. But again, losing money is not putting America first. Creating inflation that's going to cost the average American $2,000 a year is not putting America first. And that $2,000 will not be felt by his constituents. Well, it will be by the true mega followers, the ones who live paycheck to paycheck. They are going to feel it. They will complain. So between now and then, grab your American whiskey because that'll be coming off the shelves. Again, retaliatory tariffs. We're going to hear more about that. Haven't heard yet from Mexico. The world, I will say as well, again, men are moving on the board, but the world has changed. We as a people on this planet have relied on America for 80 years to defend us. That's over. It is totally over. The Republicans came to be the party of peace. I'm not buying into that, but a few years of stats prove that, but it could just be timing, whatever. You are going to see a rearmament, I think, by other nations. Will America cut back? I don't know. To sort of offset the spend, I find that sort of hard to believe. You're seeing a bit of a turn in Lockheed Martin. I'm not buying that stock per se, but the world has to rethink its partners, its friends, and how it's going to protect itself and take care of itself. We cannot rely on the Americans anymore. The situation in Ukraine, that continues to be front and center. Greenland, comical, but on the table, go figure. Panama Canal, I think that's already done. I think he already took that over. And he hasn't called us the 51st state in about 48 hours, which is nice, but he certainly has insulted us as a people a whole lot. And again, it's very emotional for all of us, but we can't be emotional when we're making money decisions. Again, it is darkest before dawn, and the more pain we feel, the sooner we're getting close to a bottom and a snap back the other way. As markets can go down quickly, they can go up quickly too. We witnessed that last Friday. On a turn, this market can rip higher and undo a lot of the damage. But unfortunately, we have to be patient, and unfortunately, we have to tolerate a bit of a discomfort. This is a chart from RBC. It speaks about trade. Again, I'm not sure how they measure uncertainty surging. It's probably a sentiment indicator. Just asking people how they feel. But again, I didn't to create the data. This is from RBC. But throughout the 80s and 90s, the world was pretty calm. North American Free Trade Agreement, trade policy pretty predictable. Businesses can do business because they can predict. All of a sudden, Donald Trump comes into power in his first term, and you see trade policy uncertainty spike. This is second term, spiked even higher. Market hates uncertainty, absolutely hates it. And we have some right now to deal with. I want to go to this next chart here. So market doesn't like uncertainty. U.S. still the biggest market. Other parts of the world attracting some attention. I don't think all the money can move there. This is exports to the United States and how significant they are to some countries. According to this data, 20% of our exports go. 20% of our exports go to America. I think that's actually 20% of American imports. I think that number is wrong. Anyway, Mexico is the #1 exporter apparently to America, followed by Vietnam. That number is very interesting to me. 26% of its exports and 20% of ours. The number at the bottom really catches my attention. Only 2% of Chinese exports end up in America. China does much of its business with Europe and other parts of Asia. Apparently not as much with America, so he can talk China all he wants. It's not very significant, I believe, to the Chinese. Likewise with the Europeans, or Germany specifically. They don't trade as much with America, according to this data. We do, of course. 80% of America's potash comes from Canada. 20% of America's oil comes from Canada. So, Trump can say he has all the oil he wants. Drill, baby, drill. He produces, or they produce, as though it's his oil. He starts to think all these companies are his companies. Truly, he does. But they produce 60 million barrels. We give them 4. That gets 20. What we don't do as a country is refine the oil. So I don't know how much of our gasoline ends up coming back into Canada from America. I think it's 80 or 90%. I could get the data point somehow, but we don't do anything in Canada other than sell 2x4s and raw barrels of oil. And then, of course, the North American auto is that back and forth, car goes back and forth over the border 6 times as we produce transmissions and brakes for them, et cetera, et cetera. But we are hewers of wood and drawers of water. We don't do a lot of added value. Nothing has changed, except that the good news, once again, with what Trump is doing, is we have to rethink our customers, rethink our friendships. And, you know, as a business person, when you lose or are at threat with your largest customer, that is very, very threatening. This is not threatening China, what's going on. It is affecting the likes of Canada, Mexico, and Vietnam. You don't hear Vietnam in the media for some reason, but because the North American part of it. But nonetheless, this is what's being affected. We can't just sit there and do nothing. As a people, as a country, we have to do something. And I think we will. I think this is the world's wake-up call from a defense point of view and from a business point of view. Diversify, self-protect, and become maybe more self-sufficient. Now, which is the next point, is economics. You know, if we have to become self-sufficient and manufacture everything ourselves, it'll be very inefficient because we can't do everything. No one can. That's why the world became flat and countries focus on what they did well. And the world was pretty harmonious until, well, the Donald had his second term. Good news is he's got 4 years. I don't think he's getting a third term. I'm not going to be in that camp. That's an outlying. I'd say absolutely not. He is going to do all the dirty work first and as quickly as possible before the midterm elections. So again, it will get better. It'll get, if nothing else, less bad at some point. But he's pushing uncertainty to no end. You know, you want to talk recession? I wouldn't be surprised to see Canada get pushed into a recession. And maybe he's going to create a recession for himself as well. I'm not there yet, but anything's possible. You got to respect the numbers. I will say the bond market is telling us something. The cost of money. When you have a hot economy and strong inflation, interest rates in the bond market reflect accordingly. In other words, they push rates higher. Interest rates have been falling. Interest rates tend to fall. This has got nothing to do with the central bank. It's got to do with the market. Is voting with its feet. It sees a slower economy. That is what you have. So it is showing up in those numbers. Good news, Canadian dollar has held that 70-cent level. You know, I won't be surprised to see 61 cents, but we're in the middle of a crisis, and the Canadian dollar hasn't really breached, well, it hasn't breached 60. It may breach 69, maybe traded 68 for a second, but it's sort of holding 70 cents. That's very impressive to me. So there's some optimism there as well. The 30-day moratorium on tariffs, the on again, off again, market hates it, driving everyone nuts. At some point, his advisor are going to have to say something to him. He's taking away some power from Elon Musk. That's interesting. I'm waiting for the two of them to have a big spat. Nothing's going to happen.
It will happen.
It will happen.
Two people with egos like that, it will happen. Absolutely.
The next chart I want to show you is very, very important. I've showed you all the time. Is it not on here? Oh, it's not on here. It's the JP Morgan chart. It's not on here. Zach? Zach can get this chart. Anyways, sorry about that, folks. I will say, every time I show you a presentation like this, we have the JP Morgan chart. It shows you the annual movement for the market. It shows you the annual high, the annual low, how much the market corrected that year, and how it finished the bar chart. And every single year, the market has a correction, almost guaranteed to have a 10% correction every year. We're in one of those right now. A 20% correction, I think, happens every 4 years, and a 50% correction happens every 10 years. So the 50% correction, I don't see it. But hey, anything's possible, but I don't see it. We're not there yet. Bear market, which is a breach of 20%, I'm not there yet. Can't rule it out, but I'm not there yet. I don't think we're ready for a bear market just based on valuations, based on earnings. But momentum has slowed down, and momentum stocks have been getting hurt. I am a momentum investor. The way I think, I like to own stuff that's going up, and I like to be out of stuff that's going down. And I use technical analysis. I use point figure charting for that. And that's the style of investor I am. I will say I am encouraging clients, you specifically, and I mentioned many times, to put more of your money into our 2 quant strategies. I have all of our strategies up here. So I'll give you a history, if I may, of the career of the Wolf on Bay Street to show you how we got to where we are today. It's been 25 years. I've been on Bay Street for 24 years. And I began basically with one portfolio when I was at RBC. And I worked around the RBC focus list, and we basically ran money very similar for all clients, holding 20 to 30 stocks, and same thing, cutting losses and holding stuff that's going up. So we started with one portfolio, and we used to call you and trade the stock accordingly, and it was very inefficient with what we did. We made money, we did fine, and we survived the financial crisis okay, and we moved forward. We came to Canaccord and took our one strategy, added in some software, but focused primarily on asset mix, and created growth, balance, conservative. So 3 different strategies to try to be a chocolate, vanilla, strawberry, something for everyone. And that worked for about 8 years. In that process, we added in some software, as SIA charts, and a quant screening tool to allow us to quickly decipher income statements, balance sheets, to find good value and seek out bad value to avoid, and incorporate that, overlay that with some technical work, but with the same mindset, own stuff that's going up of quality and avoid stuff that's going down. So we like good brands, we like companies with rising sales, we like business we understand, leaders in their category, stuff that we've spoken to you about, which brought us into our 2 quant strategies. We call them quant because we use quantitative analysis to come up with the watch list, and then we trade the watch list with technicals. So this is our S&P strategy. Year to date, it might be down, I don't know, 2.5%, maybe as of today, maybe 3%. It's holding very, very well. We've been running it now for 2 years. It's up about 43% since inception over a 2-year period, hugging the benchmark quite well. And again, we are a equal weight managers. We don't base our buys on market cap weight as the indexes do. If you don't understand that, I can talk to you offline about that. But so we started with one portfolio, moved to 3 when we got discretionary, growth, balance, conservative, and now we added 2 quant strategies, one for the U.S., one for the Canadian market. So if you want to focus specifically on the U.S., try to beat the U.S. market, the S&P strategy is the one to do. Likewise with Canada. Canada has, as I showed you on the first slide, about 3,500 companies listed. 3,000 of those companies are garbage. I wouldn't buy them. 500 are okay. There's probably 150 pretty good companies in Canada. Maybe, I wouldn't even go as far as 200. I don't think we have 200 great companies. We maybe have 150 good companies in Canada that I'm comfortable buying, that have enough liquidity, that are big enough. So of course your banks and your pipes and your oils, a couple of senior golds, et cetera, et cetera. Speaking of gold, I don't like gold miners. They've been a disaster for 3 decades. This quant strategy has me buying golds. I don't like Gildan Active underwear. Gildan Activewear, they make underwear. Don't like the company. This strategy takes my biases, puts them on the shelf, and directs me to buy Gildan Activewear. Same with Dollarama. So why I like these strategies is I put the inputs in, but then they sort of direct me into stuff I need to buy and need to sell. And we have a very hard sell discipline, which protects us to the downside, and it keeps us in the winning trades. So I really, really like this process. I think it is as institutional and as sophisticated as can be offered. We have wholesalers coming into our office once a week pitching us their products. We always show them what we do, and they're always hugely impressed with our work. So we've taken this business for 24 years and built something of process that we can define in an elevator, which most advisors on the street cannot do. Fact. There's not a single advisor that does and posts and publishes their work the way we do. So very, very professional. Again, this is the work of the last 5 years, creating these 2 quant strategies, but we've taken it again to the next level. There are managers out there who are better than us, without question. The question is, can we find them? And fortunately, I think we have. We found some managers who I think are better than us. If not better, at least different. And if not different, at least able to do stuff that I cannot do, or at least as well as them. In the bond market, I know I can't trade bonds because it's a global market. So there we've always used managers. I don't like the bond market per se, because interest rates are too low. The opportunity to make money is very low in the debt market. It can be done, but it's an outlying aspect. But we made money. We've compounded wealth over decades, in that 10% range, give or take 0.5%, because we owned stocks, blue chip stocks. I continue to be in favor primarily of blue chip stocks. There are some outside managers that I now have access to at a very low cost, extremely low cost. And depending on what the fee rate is, we tend to split it with clients, but it's negligible, cheaper than most ETFs, which we are able to trade in these mandates. I put some money with Morgan Stanley, some personal money, and I put some money with AGF. Morgan Stanley is a concentrated portfolio, 15 to 20 holdings. It is a global portfolio, which I like. It requires more work. It's harder to get the data on global companies. And as such, Morgan Stanley, who is an international asset management firm of the highest quality, we own their stock, by the way, in the S&P 500. Canaccord has a partnership with them. We have access to their full suite of equity research, which is second to none on the street. And they use all this work to create some portfolios that are institutionally offered. So in other words, to pension funds, hedge funds, and also to certain partners. Canaccord is blessed to be one of those partners. We at Canaccord use a third party to screen the outside managers to make sure that they are true to style, true to form, not too much risk managed, to make a short list. So there are thousands of managers in the universe that we have access to, but our firm spends extra money with a third party, hundreds of thousands of dollars a year to hire a third party to help screen it down into a very workable list of managers that are very suitable for my clients, for people like you. Morgan Stanley's asset product is one. If you look at their returns, they have been stellar. Very, very good for very good fees. Good returns over the course of time. Morgan Stanley's probably in line with our returns, maybe slightly better, I guess, but in line on the 10-year. Their 5-year is maybe slightly better. 3-year index, there's the index down below. So the returns have been very, very good. And the AGFs have been even better. I'll scroll down this page here. Here are the AGF investments. Absolutely phenomenal. Their 10-year number is 17%. I think mine's 12. You'll see it. Their inception number 19, mine's I think 13. So remarkable. It's a 40 stock portfolio. Again, I put some of my money into this portfolio this year. I gave them a little bit of money last year. So I've been monitoring them, their work. I meet my own footing. And as such, I think it is very suitable. Very process driven, different than Jack and I think complementary. Risk factors are similar to the way we manage money. So you will get more upside, you will get more downside. It's called alpha or beta, call it what you want. But they operate out of committees of 10, 12 people working on these portfolios. So I'm encouraging clients to allocate some of the growth balance conservative money into the quant strategies and our third-party managers for a more global portfolio, a style diverse portfolio, and I think overall you'd end up making more money on a net basis over time. Again, we're going to continue to monitor the situation. It does not go straight down the market. The economy is not ruined yet. I repeat, Donald Trump will be forced to make the right decisions by Mr. Market. And so as much as the Trumpians can love Trump, the market is saying you're wrong. And internationally, it's just putting things under pressure. But it will settle out. Jack, I'll throw it over to you. Please share with our friends your thoughts.
Sure. Just quickly, over the last couple of days, I've had a number of clients on calls talking about how stressful the markets have been. And some of them were even saying it's worse than 2008 and COVID. And my comment to them was, it feels worse because you don't know what's in front of you with the tariffs and with Trump. But if you look at what the market is, we're inside of a 10% correction. It has been created by, as far as I'm concerned, Trump and his administration. I do believe that he's getting the very difficult policies out in front, which is opposite of what he did last time around. So he's attacking tariffs. He's attacking his trading partners. It's not good for the economy. It's not good for growth. It is showing up in the fixed income market as well as the stock market, meaning that yields are going down for the time being. He's getting his difficult policies out first, as I said, but the pro-growth policies that the market got really excited about in November, they're still in front of us. So the less regulation, less taxes, pro-business, pro-growth, I believe that over time, the more extreme he gets on the negative side of things with tariffs, the sooner that policy comes through. And not only that, I think he's creating a pivot globally where countries, you're seeing it in Germany, you're seeing it in Japan, you will see it in Canada when we get a change in government, where governments are now focused on pro-growth, pro-business, because if you want to have all the things that people want, as Wolfgang said, you need to have self-sufficiency, but you also need to be able to take care of yourselves and be able to export stuff that people want in the world. So whether it's LNG in Canada that we've blocked for a long time, whether it's finding new places to export our energy, you talk about potash, like these are all primary input costs that are going into American goods. They're coming to us for a reason, because of economies of scale, because we produce them better than anyone else. We need to look at doing that opportunity and taking it globally. So to speak to this environment that we're in right now being worse than previous crisis, I really don't believe that. I do believe that the news cycle right now is much heavier than it has been in the past. I think that's where people are getting their market views from, whether it's social media, Fox News, whatever the case. And that is driving some extreme emotions. And typically when you trade on emotions, it's not the right thing to do. So the strategies that we have here, high quality strategies, great businesses, driven by process. We continue to refine our process and improve it over time. And I think those quant strategies that Wolfgang is highlighting is a good example of that. And then we've got great partners with our institutional third-party managers, Morgan Stanley, AGF, and we also have Guardian if you're looking for a value type manager in Canada.
Yeah, it's not supposed to be fun. And like I said, I feel your pain. I feel your emotions. I empathize, I sympathize, I agree with you. But level heads will prevail, or senior heads will prevail. This will pass. And as long as we own good stuff, we will get through it. Again, we own diversified portfolios, little healthcare, lots of banks, big companies that have sales that are going up. So very, very important. That's what gets you through periods of crisis. Anyways, we continue to monitor. We will continue to service you. Feel free to reach out to us. Come in and see us. We encourage that. We can review all of our offerings. And again, some of you know I'm a culinary fellow. Again, when I first opened up my restaurant on Bay Street, so to speak, I had one item on the menu. Well, we now have 10 items on the menu, and each item tastes a little different. So we're more than happy to talk to you about those items in detail. But it's all about taking care of you, and that is our focus each and every day. So we do the worrying for you. If that gives you any solace, you needn't worry. You get frustrated, but you needn't worry. You're paying us to worry for you. So we will continue to keep eyes wide open, ears wide open, and apply as much common sense to our portfolio construction and management as we possibly can. On that note, I will wish you a great weekend. Thank you for your time, and know that we're here for you. All the best.